Dear investors, we have had a difficult period since the beginning of the calendar year. While indices had started to correct from September 24 onwards, the high growth part where we are exposed took a hit from January as currencies wobbled and leveraged investors cut position. Yields increased in the US from a 3.7 to a 4.8 kind of a range, and yield sensitive investors again sold here to go to the US. Similarly, several things happened one after the other. Cheap Chinese valuations caused money to move to that region, especially as it began to perform strongly, coinciding with DeepSeek launch. If we look at FPI actions in the new year across emerging markets, we find that except Brazil, all major markets have seen FPI selling and almost commensurate with their market cap. We fall somewhere in the middle amongst other emerging markets. This points to same common factors working against all EMs rather than any country specific factor, and validates our view that bond yields and currency moves were the key reason for the sharp correction seen in the Jan to first week of March kind of a period. Of course, quickly followed by uptake in Chinese equity, which pulled monies from all other EMs. As we end March 25, some of these factors have become relatively more benign. US markets have become more pricey versus ours. Chinese markets have had a large outperformance versus us, and the valuation differentials have converged. Outflow of money to China and US should hence be expected to reduce. US 10-year yields have declined to 4.3 from a recent peak of over 4.8. And once again should be sucking in less money from elsewhere. US dollar index has also fallen. Now INR has retained stability at around 87 to the USD, which should again encourage levered players to take positions over a period of time. Happily, trade deficit has reduced and a drop in oil prices aids sentiment further. Lower trade deficit points to sustainability of the current currency levels, encouraging equity market participants to resume normal activity. On the domestic front, the end of the year related trades should also be getting closed, reducing the selling pressure further. We had covered some of these factors in our last edition and had expected foreign selling pressure to reduce, which it has happily. At the same time, in the new fiscal, the retail HNI selling pressure should also reduce. On the domestic front, the flows into MFs have remained strong while they have fallen in intensity versus the October to a December period. Cash levels in mutual funds are high. Domestic macros are seen to be improving. GST collections are up, power demand is sharply up, RBI has reduced interest rates once and may do more cuts as we go forward. On controlled inflationary pressures, it has also injected liquidity in the system. We think these factors should aid a revival in investor sentiment. Now, Q4 result season is around the corner. Industry seems to be confident of delivering a strong Q4. IIP numbers have been strong, indicating strong Q4 for industrials. From now on, as we go forward, the earning base would remain favorable for 3 to 4 quarters. And over time this should further aid sentiment. Industrials have borne the brunt of selling pressure, and a strong Q4 should go a long way in addressing some of the concerns. We believe that spaces like EMS and renewables could deliver above expectation numbers. Outlook for a warm summer helps consumer durable companies, the sentiment on that part. Global geopolitics helps outlook on defense. March has seen some more ordering in defense, addressing some concerns on that count. Now, lower interest rates helps outlook on NBFCs and also real estate. Chemical companies should deliver strong YOY results. The base here is benign. Consumer tech companies have reset expectations and we remain positive here. Now, capital market companies could deliver weaker results on lower equity volumes. As a house, we have reduced our exposure here. Spaces like IT and banks, where we are less represented, had seen outlook improve 2 months back, something that we had noted, and this space did perform relatively strongly. However, outlook for IT clearly seems to be getting impacted on prospects of a US slowdown. Banks should also see names getting squeezed as interest rates go down. With large heavy sectors in the index, IT and banks taking a breather, it should provide tailwinds to alpha creation. Now, if we look at the context of the time, strong quarterly results, should I say relatively strong quarterly results, should come in when the stock prices have seen a sharp correction. And most stocks are trading at levels seen over 6 months back. From these levels, a good quarter two had worked well for growth space, which gives us hope that a good quarter four could do an encore. This leaves US import taxation the prime fear in the market. On this count, our belief is that India would see import duty levy similar to other nations. Import duties are a source of revenue for the US. They would seek to manufacture the strategically important stuff internally while continuing to source other stuff from abroad. In this scenario, the impact of import duty in the US is like it's a tax on their own consumers, like a GST that our country imposes, and does not impact market access of one player over the other. However, key target of the US seems to be China, and we are hopeful of a more favorable term versus that country and countries through whom China routes its product. Better market access to the US should result in a net positive outcome for India, even corrected for any economic slowdown seen there, and would help Make in India initiative. Moreover, India is a domestically focused economy. Most of the names in our portfolio benefit from India growth story, while our trade surplus with the US looks large. The value addition in spaces like cell phone assembly, jewelry, petchem, etc. is very low. And approximately US dollar 40 billion trade surplus is just around 1% of our GDP. And if we look at value addition, which is the correct measure, GDP is the sum total of value addition in the country, it is even smaller. Now, we note that Europe has a larger integration with the US, and their markets are doing fine as they seek to indigenize and strengthen their armed forces, as are actually Chinese market. Hence, we believe that fears of what a US may do may not be as relevant. Our market suffered on account of currency and interest rate movements, and these are settling down. We believe that versus FTAs with the East, which had similar cost structures as ours and were not favorable to us, the FTAs with the West, EU and the US, stuff that we hear would take place over the next 1 year, should prove beneficial on complementary strengths. In any case, the outcome of tariff would be known on April 2, a day after the video gets to you, and more calculated decision can be then taken. To sum up our thoughts on this topic, we do believe there would be higher import duties on all import. However, with concessions that are being extended from our side, we could get a more favored deal versus some of our largest competition, and that could be beneficial to us. In any case, representation of some of the largest exports to the US in the market, in the stock market, textiles, gems, etc. is very limited. Electronic exports, e.g., Apple phones, etc., have a very low value add in India, and the ecosystem again is not there in the listed domain. Valuations have become favorable and below 10-year average levels. Economy is experiencing an uptake. Large cap, mid cap, flexi cap, and small cap indices have all delivered returns below earnings growth over this fiscal, implying that over a period of a year, all have become relatively cheaper. And outlook of strong earnings growth over the next 3 to 4 quarters, assisted by low base, increases the odds of a favorable market over the new fiscal. We take further strength from the fact that while Jan-Feb are relatively weak months in India, the rest of the year usually makes up for the weakness. Chart shows you how it has been over the past 16 years. We have stress tested our portfolios for export linkage to the US, spaces which may get impacted on larger Indian market access to US companies, and three, cash on book and near term and long term growth visibility. I think most of our companies have cash on book with a very strong near term and long period growth visibility. On the US market access and our export linkages, we find only 15% of any portfolio exposed. Here again, outcomes can be beneficial as well. Spaces like EMS, renewables, capital markets, NBFCs and banks, luxury consumption, defense, etc. are all domestic focused spaces and are not impacted by potentially higher imports from the US. Higher preferred access to the US market for Indian produce could be a significant positive. Keeping fingers crossed on that. The thought of excess global produce being dumped into India is a risk. However, the ability of the government to protect Indian industry from such an event is high, given the backdrop of what the US is doing. We believe that space, which have seen a sharp correction on technical reasons like currency and interest rates, rather than fundamental reasons, should be the space to hunt for ideas for a strong pullback. With that, thank you, happy investing, and may the good times continue.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.